Hey, Saretsky here. Welcome back to the show. Incredible week here in the Canadian landscape. Going to touch this week on the federal government basically imploding before our very own eyes. I want to talk on the Canadian dollar. That's one of our core themes. We had some big updates on that this week. We got some update from Canada's CPI data. We've got some updates from the Fed. So a lot of our core themes are playing out. They're playing out in front of our own very eyes. And so I want to walk you through all of that. But first and foremost, of course, if you follow the Loonie Hour podcast that I put out with my co-host there, we did a more in-depth conversation. So I would highly encourage you to go check that out. But for all intents and purposes, the housing minister Sean Fraser, he stepped aside last weekend, says I'm not coming back. This ship is sinking, and I'm just gonna basically go into the private sector or do whatever he needs to do. So Sean Fraser's out, the housing minister, the guy that actually destroyed our immigration file first and then moved the housing. He's out. And then we had Freeland, the finance minister, step back and basically throw Trudeau under the bus and said, I'm out. This guy's not listening to me. He doesn't listen to anybody, so I'm out. And so now we've got threats from Jagmeet Singh today saying that apparently he's going to call a non-confidence vote when Parliament returns January 27th. Of course, the election period, I think, will take about 36 days, at which point Jagmeet will be eligible for his full pension. So the timing works out. That seems to be how the cards are lining up today. But again, Sean Fraser's out, housing minister's out. The new housing minister is Nathaniel Erskine Smith, also has zero housing experience, so I'm sure that will go probably about as well as the last few housing ministers have done. So he's in. We've got a new finance minister, of course. On Monday, we learned that the deficit was a disaster. Again, keep in mind we were promised a fiscal guardrail of a budget deficit that would not exceed $40 billion. And we hit $62 billion. So we missed by just over 50%. I suppose one could call it a small rounding error. And this really comes back to the fiscal mismanagement this country's currently mired in. We know that GDP per capita has been declining for 6 or 7 consecutive quarters. So the public finances are really just a mess. And so, and this is really what we're seeing just at various levels, and which I'm going to get into, when we talk about really where we see assets and things that are playing out in real time. And so we've talked a lot about the release valve being the Canadian dollar, which is, listen, the Canadian economy, it just doesn't have a lot going for it. Again, you can blame the current government. I don't think they're completely to blame, but they certainly haven't helped the economic and financial situation of this country. I think it's a complete mess. And so the Bank of Canada knows this. They say, well, the labor market's really soft. It's taking people a lot longer to find jobs. The supply exceeds the demand. In the labor market, we need to cut rates. We had CPI inflation came out today. That looks muted. I mean, let's be honest. You look at CPI, headline inflation, it's right on the screws at 2%. There's really not an inflation problem today in Canada. Yes, real prices are up dramatically over the last 3-4 years, but that's really a story of 12, 24 months ago when we were printing, billions and billions of dollars and flooding the economy with cheap interest rates. But the story today is like you've got a really weak economy. It's running below its potential. You've got a labor market that's in slack. And so there's really not an inflation issue today. So the Bank of Canada has been aggressively cutting rates. And of course, what that's actually doing is, again, the release valve being the Canadian dollar. It's weakening the Canadian dollar. The loonie at one point this week hitting 69 cents. 69 cents. Outside the pandemic, it was like the lowest in almost 20 years. So the currency has been really under pressure. Now that will create inflationary dynamics potentially at some point in 2025. So this is really the loonie and inflation and importing inflation. That's really a 2025 story, assuming the loonie continues to move lower. And why did it move lower? Well, it moved lower because what we've been talking about on the show for many, many, many months now, which is the economy in the U.S. is just so much stronger than the Canadian economy. It's so much stronger than many other global markets that the Fed doesn't really have a whole lot of reason to be cutting rates. In fact, he came out and said, listen, we cut rates 25 basis points this week, but we might be done. We might be done. Now, they're forecasting 2 more cuts next year, so total of 50 basis points. But I think for all intents and purposes, they're not going to get there because if you look at it, what's happening is the markets, the bond market is pushing back on the Fed, and they're saying to the U.S. Federal Reserve, Jay Powell, they're saying this is a policy mistake. This is a policy mistake. If you look at the 10-year yield during rate cut cycles, the 10-year yield has been moving higher. It's been moving higher and higher since the Fed starting cutting rates, suggesting that growth and inflation are going to pick up. That's what the bond market is saying. And so they're saying the Fed is not serious on inflation, and they're pushing the long end of the curve higher. And this has only really happened during previous times when inflation reignited. So the bond market is telling you the Fed doesn't have inflation under control. The Fed shouldn't be cutting rates. And so I think the highest probability here is that the Fed is done or almost done. And so that puts the Canadian dollar and the Bank of Canada in a very difficult predicament. Is also pulling our bond yields domestically here slightly higher. And so again, for Canadians, what does this mean for Canadians? It means for Canadians that are renewing mortgages today and early into 2025, the fixed mortgage rates aren't going to get any better. The fixed mortgage rates aren't going to get any better. So that's an important setup for you if you guys are out there and wondering what to do with your mortgage. If you're renewing, I mean, there's a huge chunk of mortgages this year. I don't know what it is, 30% of mortgages renewing this year. So if you're renewing a mortgage and you're saying, oh, I'm hoping to get back down into the mid threes or something, the bond market is telling you that's not going to happen. So I think that's some important context. We also learned this week from OSFI. OSFI is the banking regulator. You'll remember they came out with an announcement earlier this year saying, okay, we're going to repeal the mortgage stress test on people that want to switch lenders. So you're at TD Bank, you want to go to RBC Bank, you're up for renewal. You want a more competitive rate, or maybe you just want to switch, you're getting better terms, etc. You want to leave TD and you want to go to RBC. We're getting word today they're actually rolling a lot of that policy back behind the curtain. And there's some dynamics that are happening for that reason. Basically, they're not sure how to adjudicate these loans, which is like a lot of the loans are what they call collateral loans. And so what it means is basically RBC's got this product, TD's got this product, Scotia's got this product, a lot of the banks have this product, whereas like if you borrow 80% loan to value, right? So you borrow 80% of the home's value, you put your 20% down. What you have is we call like these like home line programs, which is basically as you pay down your mortgage, right? Every month you pay a little bit of principal. That balance becomes readily available where you can actually re-tap it and re-borrow it on a home equity line of credit. So it's called a collateral type of loan. And so OSFI is saying, oh gosh, we're not really sure. Maybe these should be stress tested. And so what we're hearing internally is that the stress test is really, it's not going to be that easy to actually switch lenders. And OSFI is in the process of actually trying to figure that out. And a lot of people are, in fact, going to get stress tested. So these are important things to keep in mind if you're a Canadian, again, coming up for a mortgage renewal next year. So again, keep in mind the core theme that we've talked about, which is, okay, listen, the Bank of Canada is going to have to cut rates. The economy stinks. It's not as strong as the U.S. The Canadian dollar is going to continue to weaken. Bond yields are pushing higher because the Fed isn't aggressively fighting inflation because they still have some inflation. Because the Fed is projecting right now that inflation is not getting back down to 2% target by till 2027. So they pushed that forecast. So that's really telling you, again, what the Fed is seeing and what the Fed is thinking today. And the bond market seems to agree that policy in the U.S. is not tight enough. Which is a very different story than what we're seeing here domestically in Canada. And so keep this all in mind as we move forward, as you're trying to figure out what's happening with home prices, as we now have to really look and say, okay, if you have a Canadian dollar at 70 cents, 69 cents, 68, 67, 65 cents, what does this mean for home prices and your overall net worth, your net wealth? And I think you really have to look at the big picture. And this is why I keep putting up the chart and saying, show Vancouver real estate prices denominated in ounces of gold. That's real money. It's been money for thousands and thousands of years. And we know that in ounces of gold, it peaked back in 2007 at 1,200 ounces. 1,200 ounces of gold to buy the average house price in Vancouver. Today, it sits at 576 ounces, and that's really just a function of the Canadian dollar losing its value, not the real estate appreciating it so much in value, but the value of the currency that you're earning in your job is actually just not buying you as many goods, despite what CPI inflation basket's going to tell you. And you can do this exact same in shares of the S&P. That peaked around, used to take about 528 shares of the S&P 500 back in 2011. Today, it takes you 133 shares of the S&P to buy the average home in Vancouver. You can then start denominating that in US dollars. We're seeing that home prices are coming off much more aggressively in US dollar terms. And so if you get any sort of appreciation in real estate next year, it could just be a function of the currency losing its value and not maintaining the value. And so that's really important, right? Because I think, I've had some conversations this past week with a lot of people that are saying, oh, I bought this real estate and some real estate's been going up. Some real estate hasn't moved anywhere. We've got real estate on the west side of Vancouver, detached dirt on the west side of Vancouver that has not appreciated in value since 2016. It's gone nowhere for 8 years. And this is prime dirt in the core of the city. You go to downtown Vancouver, condos have not moved in price since 2018. People are saying, well, there's no appreciation. Meanwhile, you go to a house in Langley, it's doubled since 2015, but that house peaked in 2022. And is it unreasonable to suggest that real estate might not move in value for 6, 7, 8, 9, 10 years? I mean, I think if you get pockets like the west side of Vancouver not moving for 8 years, I think it's very realistic to suggest the suburbs could just follow suit as well. And so, again, I put that into context of overall value of your household net worth. You really have to start thinking outside of just Canadian dollars. I mean, people on this channel like to give me a hard time about, Bitcoin, you don't talk enough about it. It used to cost you in 2015, used to cost you 2,500 Bitcoins to buy the average house price in Vancouver. And today sits at 9.4 Bitcoin. So you have to look at overall asset classes when determining this, especially when you start overlaying it with the fiscal horror show that is the Canadian political system that is destroying our finances in the process. As you run these massive deficits, is ultimately just a larger debasement of the currency. And so these are just things that I think about. I think that, that's why I always say to people, I love that everyone just forecasts infinite price growth in Vancouver real estate, but not really adjusting for inflation or into other currencies or other asset classes. Again, I still think real estate has a very important place and role to play in protecting and preserving net worth, as it has for thousands and thousands of years. But I think it's important to contextualize. Of course, your home that you live in also has that utility factor where you need to live somewhere. But I think this is all important as we sort of look at holistically all the pieces that are coming together. We see what's happening in government. We see what's happening with interest rates. We see what's happening in the currency markets. And now we see what the bond market is telling us. I think this all plays into domestically here, Canadian real estate, where I am, Vancouver real estate, and looking at the big picture moving forward. So that's kind of what my thoughts heading into 2025. We'll probably continue to do. I'll probably put out another video or two in the holiday period here. But if I miss a week, forgive me. But we'll keep a close eye. I think there's lots happening in the markets today, which there usually isn't this time of year. There's a lot going on. So I wanted to jump on this week, and I'll probably jump on in the next week as well. So hope that helped. Merry Christmas, and appreciate your guys' support throughout all of 2024. Looking forward to continuing to follow these markets, continuing to do my best to educate you and keep you updated in terms of what's happening in the housing market in 2025. See ya.